Okay, at the end of each reporting period, we prepare a pre-adjustment trial balance, which is basically just a list of all of the general ledger accounts and their balances at the end of the reporting period. These balances could be a debit balance or a credit balance. Certain ledger accounts always have a particular balance no matter what. So, for example, inventory will always have a debit balance because it's just impossible for a business to have negative inventory because that's a physical product that they have in their hands. So, it literally is impossible for the business to go into the negatives with inventory. Another example is accounts receivable. Accounts receivable will always have a debit balance because it's an amount owed to the business from customers. Another example, loan accounts will always have a credit balance because it will be an amount owed by the business to the bank. Accounts payable will always have a credit balance because it's an amount owed by the business to suppliers. There are other ledger accounts that can have either a debit or a credit balance. So this includes bank because the business could have a positive bank balance or a negative bank balance. And then another example is GST clearing, which we just went over. So obviously GST clearing can either be a liability or an asset, and so therefore it's possible for it to have a credit or a debit balance. So here's an example of what a completed pre-adjustment trial balance looks like. You can see 3 columns, account, debit, and credit. In the account column is a list of the names of every single account from the general ledger of the business. So every single general ledger account that the business has is included in that list under account. So they have a bank account, an inventory account, an accounts receivable account, an accounts payable account, a loan account, credit sales, cost of sales, wages expense, and owner's equity or owner's capital. Then beside each account name is the balance of that account at the end of the period. So if the account has a debit balance, then that balance amount is under the debit column, and if the account has a credit balance, then that balance amount is under the credit column. Then you can see in the bottom line there's the totals. So we have the total of all debit balances and the total of all credit balances. And if all of the recording of the business has been done correctly and there's been no mistakes, then ideally, both of these balances should match because, like I said before, under double entry accounting, all of the debit entries must be equal to all of the credit entries, and so therefore, at the end of the period, all debit balances must be equal to all credit balances. So all debits should be equal to all credits, and so the balances should be the same. And as we saw, the pre-adjustment trial balance lists all ledger accounts and their balances, but how do we get those balances? So there are a few balancing methods. The first one is footing, which is basically a method of informally calculating the balances of accounts for the pre-adjustment trial balance. There are 3 steps to footing. Number 1, total all debits of the account on the left and all credits of the account on the right. 2, deduct the smaller total from the large total, which will give the balance of the account, and then write this balance on the side that had the larger total. So here's an example of a completed general ledger account from the end of a reporting period. So first we'll total the debit side, or the left side, and this debit total comes to $18,000. Next we'll total the right side, which is the credit side, and the credit total comes to $9,800. The next step is we subtract the smaller total from the larger total. So the smaller total is $9,800, which is the credit total, and the larger total is $18,000, which is the debit total. So we'll do $18,000 minus $9,800, which gives us $8,200. So this is the balance of the account. And then the final step is to write this balance under the side that had the larger balance. So in this case, that's the left side. So we'll write the balance $8,200 under the debit side of the ledger account. And lastly, we just put a circle around that balance to clearly show that that's the balance of the account. So that's footing. That's how we do footing. It's, like I said, it's informal. So when we're actually balancing the ledger accounts, we'll need to be a bit more, like actually write the totals down properly, but this is just an informal way of balancing an account. Okay, it's also important that you know the purpose of the pre-adjustment trial balance. You can be asked this in a theory question, and basically the reason why we prepare a pre-adjustment trial balance is to use it as a double-checking mechanism. So going back to our completed pre-adjustment trial balance, what we're double-checking is these totals. Like I said before, the totals of the pre-adjustment trial balance have to match. So all debits must equal to all credits, and so the debit and credit balances should match. The total should match. If the totals don't match, then we have to check for and correct any mistakes or any errors we might have made. So common errors that are made in double entry accounting include incorrect calculations, for example, calculating GST wrong amounts, so the amounts could be copied incorrectly from the source document. For example, if the source document says $1,000 but you accidentally write $10,000. Another common mistake is the wrong accounts. So for example, if someone accidentally debits accounts payable instead of debiting accounts receivable, or other examples, and that's just mistakes that people make. And then the last common mistake is swapping the debit and credit. So for example, you debited accounts receivable and credited bank instead of crediting accounts receivable and debiting bank. After we've identified any errors and we fix those errors and our pre-adjustment trial balance, the balances match, then we can formally balance the ledger accounts. And this is called balancing, which is basically the formal version of footing. It's important to note that only asset liability and owner's equity accounts are balanced. We do not balance revenue and expense accounts. And there's a 3-step process to balancing. Number 1, we total all debits and credits. So whatever the larger total is, we write it on both sides. And then we calculate the balance of the account by subtracting the smaller total from the large total, and then we add the balance in as an entry and match the balance to carry it forward to the next reporting period. And another key tip is to only balance a ledger account when VCAR explicitly asks you to. So similar to like the narration, the question will tell you whether they want you to include a narration or not. And another is similar with balancing. The question will tell you whether they want you to include balancing or not.